video, we're going to talk about the golden crossover. We're going to go over how to set it up on your charts and how to trade it. We're going to talk about the pros and cons. We'll also include the difference between the golden cross and the death cross. At the end, we're going to talk about different variations to amplify your trading. The first step of the golden crossover is finding the trend. For that, we're going to use the simple moving average 200. When you click on your simple moving average, you might have to increase the length to 200. Depending on how big you want the SMA to be, you can do the width adjustment or the color. And you can see why everybody likes using the 200 moving average for a trend. When the stock price is above the 200 moving average, it tends to go up. And when it's under the 200 moving average, it tends to go down. The 200 moving average can have some big pullbacks back to it and then moves trend continuation higher. And this is why traders love it, because sometimes the pullbacks are small, but the runs are really big. But be aware, sometimes the pullbacks are big and the run up is small in nature. Sometimes the pullbacks to the moving average can take a long time. This was over 6 months, but the results were worth the wait. Then you had another sideways consolidation for 6 more months before bouncing off the long-term trend, and price ran up higher. You can see price bounced off the trend line again of the 200-day moving average. To get the golden crossover on your charts, apply the simple moving average 50. Same as before, type it in here, adjust your color and length. For this, I'm going to do blue. And here's the golden crossover signal. When the 50 moving average comes over the 200 moving average, it means that it's bullish. Why? Because the 50 moving average is used as momentum, meaning that it will move up and down faster than the 200. See how the angle of the 50 moving average is upward at about 45 degrees, when the 200 moving average is kind of flat. Really, for this whole time, the 200 has been flat. The 50 moving average will have more of a curvature towards the stock price, moving back and forth. So you know when the 200 moving average is giving you the same upward angle as the 50 moving average, it's extremely bullish. Another way to look at it, as the price gets further away from the 200 moving average, you know you're at extreme highs. When it's close to the 200 moving average, you know you're in consolidation. On this chart, you can see the moving average was also very flat because of the 2000 sell-off. Here's the golden crossover signal with a phenomenal run up, and that's why traders love it. And technically, you would still be in this trade until you get a death cross like this, but that's for later education. Here's a little different variation of the charts where the 200 went sideways, it made a death cross, but then quickly made a golden crossover. You can see the 45-degree or more angle on the 50 moving average, along with price, the consolidation back to the 200 moving average, and then the run up again. Came very close to a death cross right here. And with price currently under the 200 and the 50 moving average, you would tend to believe you're going to bump up against this resistance and then it starts selling off, kind of like it did back here. Now back to our first example, ADI. Waiting until the 50 moves over top of the 200 moving average to get into a trade, you have two considerations. You can get into the trade on a 50 bounce if you're aggressive, but if you're more conservative, you might want to use the 200-day moving average for price to come back down to before getting into the trade long. Of course, this would yield you a little bit more profits and time. Depending on what you want to have happen with your portfolio, you could either take targets once price breaks below the 50 moving average because you're aware that consolidation will happen, or you can hold till you get the death cross, letting your runners run. Knowing this is a buy and hold trend continuation, some traders will look for price to come over the 50 moving average, then pull back and enter into the trade. When price crosses over it again, they wait for the stock to pull back up to it to get out of the trade. But in consolidation, if you were to enter in here, price did sell off a little bit lower. The more conservative view would be using the 200-day average, giving you bigger moves. Our next chart, ADM, golden crossover. If you use the 50 moving average as an entry point, this would have been a great trade for you, giving you huge profits. If you were waiting for price to come back to the 200-day moving average, you would have never gotten into this trade. Price came over the 50-day moving average, pulled back down to the 200. Great place to enter to the trade long. Then let your runners run. Autodesk, golden crossover. And you can see it was very hard to get into this trade. Price just ran up. It did come to the 50-day moving average, allowing you to get in, but from there sold off a little bit lower, never getting you in on the 200-day moving average. If you were more conservative, you would have never been able to get into this trade. Maybe you create a rule that you can get in at this trade, but most traders like a break above, then a pullback to retest before price goes long. Now for some pros and cons of the moving average crosses. One is that it doesn't always come back to the 200-day moving average to get you into the trade. Another is if you use the 50-day moving average, there's a high likelihood that price will go back a little bit lower. Another problem for me is when you enter into the trade, there's nowhere to pick your targets. to figure out what your risk to reward would be. A lot of traders would use the 200-day moving average and said if price broke below, they would exit the trade. I guess you could do a 3 range box risk to reward to take your targets. But if you entered into the trade here and you were using a trailing stop, what would it be? If you said it was going to be the 200-day moving average, that's great. But at what point would you move up to the 50-day moving average? And if you did move it up to the 50-day moving average, would you have been stopped out there? Basically not making any money. Using the moving average as a trailing stop as price goes up is a smart idea. You might want to make sure that the moving average is in a 45-degree range when doing that. Something a lot of traders like about the golden crossover is get into the trade and let stock price move without having to consider what it's doing every day. If you were to got in here, the stock price has run up 45% in the last 2 years. If you would have got in here, the stock price went up over 55% in the last 2 years, which is more than 8% average. Another thing I don't like is that the moving average is a lagger. We're on ADI and we're going to zoom in. If you look at the death cross, it happened right here, basically at the lowest low of the 2020 crash. This would have really hurt your portfolio. In this case, it moved over 30% in just 30 days. ADM, zoom in, and you can see the same thing. Almost absolutely at the lowest low is when you got the crossover. What if you would have got into the 50-day moving average here, anticipating that the death cross was going to go much lower, at least down to the old lows and make a double bottom. Then after the consolidation, it rockets back up. The death cross entry would have been a losing trade. Now, it's absolutely important that you know what the trend is so that you can trade with the trend, either up or down. Now that we've identified and shown that the moving average is a little bit of a lagger, what can you do differently? I'm not going to leave you hanging. It's the polynomial channel. There are pros and cons to the polynomial channel. The pro is it would have got you in at the absolute bottom before the golden crossover pullback, which was a 35% move in just over 130 days. The next benefit of the polynomial channel is just like the 200-day moving average, it shows you the trend. When it's up, price continues that direction. The other thing about the polynomial channel is it's clear. Buy low at support, sell high up against resistance, giving you the max amount of money. If you were able to get out here at a high, instead of waiting for price to come below the moving average to exit the trade, just that little move would have saved you another 10%. AMD polynomial entry at support instead of waiting for the golden crossover and then price to come back down to the moving average to get into the trade, which was a 42% in 200 days. That's a lot of money. Next thing we can see, the polynomial resistance gave you a great place to exit the trade, saving you time because of this big consolidation and being patient enough not to get back into the trade until it comes back down to support. If you only want the best entries, enter here at support or wait for the 200 moving crossover and then wait a little bit longer for a support bounce on the 50-day moving average, or wait for it to come down to the 200 moving average, which it never did. Using the polynomial channel, enter and exit. You would have made 125% in just 300 days. Yes, price did make another double top. That was only a 6% higher gain. After making 125%, do you really need more? But remember what we said about the polynomial. When it's uptrending, take the up trades. When it's consolidating sideways and even peaking a little bit lower, that's when you'll start to take lower trades, which the 250 moving average are showing us also for a death cross. In some cases, stocks are so bullish, they'll never give you the golden crossover, or it's very faint. But with the polynomial support entry, it is very clear. Enter here and exit at the highs. Right here, we see the death cross, but the polynomial is showing a good bounce because the channel's going upward. The moving crossover can be a little bit difficult, whipsawing you in and out of a trade, thinking it should go up, but then it just comes back down, giving you bad alerts. Now here's the death cross, where price is under the 200-day moving average, was under the 50-day moving average, but now is coming and retesting that 200-day moving average, which would be a great place to short this. Just using the polynomial, it's easier to see. We have a downtrend channel, up against resistance, ready to short, down to old lows, and even lower. I hope this helps bring a little bit more understanding to your trading system on the 200-day moving average crossover system. There's going to be some variations that you're going to have to create in using that because it's so sporadic. Entry points, exits, targets. Are you going to use trailing stops, double down, versus the polynomial that's a little bit cleaner? Is the trend going up or down? If it's going up, are you at support? If it's going down, are you at resistance? Using the polynomial support and resistance as a trailing stop, and it also draws out your targets, midpoint and the opposite side of the channel. If you'd like to learn more about the polynomial channel, go to the link in our description, stockchartstrading.com.